Now that the U.S. is restricting some semiconductor sales to China, what is the market like outlook for semiconductor stocks and ETFs? And would this be a good buying opportunity since they're kind of pushed down right now?
Yeah, we saw, you know, Nvidia drop 11% this week because of their announcement that the U.S. is restricting their ability to sell some of the high-end chips to China, artificial intelligence, those types of things. And so it's the beginning of a kind of a continuation of a trade war in a lot of ways. It wasn't, it was $400 million, which is a lot of money, but it's not that much money to Nvidia. It was probably a little bit of an overreaction, in my opinion. And I know Kathy Wood with the ARK funds bought a lot of Nvidia, for example, so she obviously saw some value there. I think one of the things I look at, though, in terms of, there's the basket of stocks you can buy, like the SOXX, the iShares Semiconductor ETF that we've had in our portfolios over the years in the past. Don't have it now per se, but the one thing I would be, it depends on timeline and what you're looking at. So semiconductors, in my opinion, are still they're on the higher end of the multiples in terms of the PE ratios across the group. You can find some cheap ones, but there's some really expensive ones. But if you look at the entire ETF, it's more expensive than the market is in general. And so one of the things that's happening because the primary trend right now is down, right? Primary trend is down. And when the primary trend is down, things that have higher multiples generally get crushed even more. And they try to bring those multiples down even further. And we've seen that this year. The semiconductors are down more than the market as a whole. There is opportunity, but you just have to have the right timeline as far as that goes. So if you're saying, hey, I think semiconductors will be worth more in 5 years, I would agree with that wholeheartedly. And yes, semiconductors are a lot cheaper than they were. So yeah, not a bad thing to do. Hey, I'm trying to make money in the next year or something like that. I don't know, right? And so I would consider, for example, one of the things that I do in my own portfolio is I have a percentage allocation to different things. So I have 4% allocated to semiconductors. And so when the market drops in that area more than the other things in my portfolio, all of a sudden I've got 3%. I'll buy more. I'll bring it back up to 4%. So that's my way of kind of dollar cost averaging back when it drops. Because again, I have at least a 5-year outlook on that, so I'm okay with that. And then if it goes to 5 or 6 or 7% of the portfolio, I let it run. And so that's my way. And I've got several categories that I do exactly like that: cloud computing, clean energy, you name it. And so I'm, just as those particular categories kind of drop, I buy more. Now, in that particular case, you got to have some conviction. You got to really, really feel good. When I put something in the portfolio like that, this is more for something I do for myself, but I got to say to myself, when that drops, I want to buy it. And so, Target, I had Target got hit pretty hard. When that dropped, I had no problem buying it. I really like Target. It's got relatively low multiples. I think what they're going through is temporary. They're a well-run company. They're really well positioned. Every time I go there, they're super busy. But it's still down for the year, because it dropped like 30% in 2 days after one of their earnings reports. But semiconductors would fit into that category for me in terms of, conviction. But in terms of, hey, how's it going to do here in the next 3 to 6 months? There could be a fair amount of pain because the overall market, it's kind of like the tide. When the tide goes up, it raises all boats. Well, the same thing happens when the tide goes down. And things that have higher multiples can sometimes come down faster than those other things. So I'd be a little careful, maybe dollar cost averaging in, or having something like I'm doing, a small percentage that you just keep buying if it does come down and let it run if it goes up. But it's a category I like overall, and I think it'll be higher in the next 5 years.
So how would you handle it if, let's say, I have $10,000 of cash and I want to get into semiconductors now? I believe it's a buying opportunity. I have a long time horizon, but I understand that the market is on a downtrend. So what would be a good strategy for, investing that $10,000?
Okay, so I'm going to assume $10,000 is some certain percentage of your overall portfolio that you have at this point in time, and so you're just going to try to fill that out. And so I would take some dollar cost averaging approach right now. 2,000 a month, 1,000 a month, something along those lines. So kind of that 5 to 10 month range, and put that money in, consistently during that period of time. And so that's going to be some percentage of my portfolio going forward. And then I just try to do what I just said, maintain that percentage. So now I'm up to 2% or 5% or whatever it is. I don't like to go real high in certain areas in my portfolios. I like to keep things diversified, but then I try to maintain that. So if I had other monies after that 10,000 and it dropped to 9,000, I'd try to bring it back up to 10, right? If it jumped up to 12, 15, okay, I'm going to let it run for a while, right? And if I see a lot of strength, sometimes I'll also buy that. Yeah, that's how I do it right now, because if we were in a primary uptrend, that wouldn't be the case. I'd probably just put the 10,000 in there and just try to, if it drops, buy some more. But we're not in a primary uptrend. We're in a primary downtrend, and we are still there. I thought we might break out. I was really hopeful. Didn't happen. And so really at this point in time, that's what a dollar cost averaging I think would be great, because if it does continue down, you continue to buy shares. If it goes up, straight up from here, you wish you would have bought all of it with 10,000, but that's okay. So something in that 5 to 10 month range would probably be pretty good.